We are just a few hours away from the Federal Reserve delivering its latest read on the economy and whether it plans to make any changes in those massive stimulus programs that have been helping keep us afloat during this pandemic. Our Fed correspondent, Brian Cheung, is joining us now with a preview. So, Brian, I guess it's a foregone conclusion, or at least widely expected, that the Fed's going to leave interest rates right near zero. But now that we have states gradually reopening and signs that the job market is starting to rebound, what do you expect to hear today from Fed Chair Jay Powell?
Alexis, as you mentioned, nothing new expected from a raw policy standpoint. The Federal Reserve slashed rates to near zero in mid-March, and they've been embarking on quantitative easing, that's asset purchases, since that point in time as well. So really the focus is going to be on forecasts. And one way that we'll get that is through the summary of economic projections. Keep in mind the Federal Reserve was originally scheduled to release forecasts on things like where inflation, where unemployment, where GDP, where the federal funds rate itself will go over the next few years. They were supposed to have a release back in March, but because of all the craziness and the emergency FOMC meetings that they had convened during that time, they actually did not release that projection at that time. So we will get a new set of that today. It'll be the first time in 2020 that we'll have those projections on those things. And it'll be quite important because it not only will tell us how long the Federal Reserve might expect the United States to be in the malaise that it's experienced as a result of the COVID-19 crisis, but more importantly, how long it might hold rates near zero to accommodate the recovery at some point in time. So the SEPs do map out where projections will be through 2022. Anything after that is kind of fair game for interpretation, but the expectation widely is that the dot plot projections that we'll get today will show the Federal Reserve not wanting to raise rates through 2022. Another few things worth watching could be things like forward guidance, whether or not the Federal Reserve will guide markets on specifically how much of asset purchases it will embark on over the next short-term period, or how long it'll keep interest rates low, in addition to things like yield curve control. Keep in mind, we've seen the 10-year have quite the rally over the last few weeks. It reached as high as 90 basis points last Friday, which means there could be some concern from the Federal Reserve that they would like to pin down longer-term borrowing costs. Those things, maybe not in this meeting, could be July or September, but Jerome Powell's press conference today could provide some clues as to those things in the future.
Brian, the pace of bond buying by the Fed, it has slowed down in recent months. What are the chances that the Fed comes out here today during the conference and suggests or hints to the market they might be willing to ramp that back up? I think the pace of slowing down is a market risk that may not be factored in right now.
Absolutely. And you could argue to what degree the Federal Reserve's tapered purchases of those treasuries have led to the rally, because the Federal Reserve effectively took the training wheels off. And now with the rally in equities, especially, there's been a lot of risk taking in the market. But I think the Federal Reserve, if they did want to embark on ramping up those purchases, might wait until they had some sort of stated policy on, let's say, for example, yield curve control. For those that aren't aware of what yield curve control is, it'd be the Federal Reserve saying, we're going to commit to buying U.S. treasuries in these short dated maturities until they're pinned below a certain stated level. So whether or not that's, say, 50 basis points on the 10-year, that could be one way they could do it. The more consensus is that they wouldn't target something as long as the 10-year. They would go for something more medium term, like a 3-year or a 5-year. But again, a lot of people saying the Federal Reserve is maybe a little bit too early on in the process to say something like that or announce the yield curve control policy in this meeting, but it's possible Jerome Powell could tee that possibility up for maybe July or September.
All right, Brian Cheung, thanks for the preview.